Welcome to Total Money Management. I'm back with Steve Moriarty. How you doing, mate?
Good, mate. Good. Ready to rock and roll.
Fireworks season, almost.
Yeah. Nearly. Yeah. When is New Year's Eve? Wednesday.
Yeah.
Yep.
You doing anything for it?
Going to bed at 11.
Yeah, I'll be in bed early. Yeah. Usually get in bed a little bit earlier that day.
It's embarrassing to say, but from probably 18 to 25, I spent most of the time being drunk and vomiting, and then going at 3 o'clock in the morning. Oh, I want to get a taxi, and of course, everyone's smashed, and there's no taxis, and they hate you because you're drunk and stuff, And then after that, it was like, no, I'm not going out. I'm staying home. Because it's a nightmare, like you go out, you can't get a taxi, and all you want to do is go home and sleep.
So many people. We end up just watching it on TV, and I'm snoring when it gets to about 10:30.
I end up watching the ABC New Year's Eve, which is pathetic, and it's like, he's Casey Donovan again with this year's songs, and then it's like some new talent that, I don't know, like they got pink hair or something, and I'm an old bloke on the couch going, what the hell's going on with today's youth? These kids will never be any good. Oh, this kid's had 85 million records. It's like, oh, right, okay.
It's a different version of good, Stephen.
yeah, it's like, where's the Rolling Stones? Where's Mick Jagger and the Beatles?
All right. Well, I thought the week that's just gone, the markets have been closed. It's been a bit of a muted week.
Yes.
There's been a classic up and down day throughout that Christmas volatility. But there's not enough really there to keep going about the same stuff. So I thought we'll mix it up a bit.
Yep.
There's been about 1 million questions come through the socials, either privately or on the videos that we post. So I thought we'll spend a bit of time going through that, because if one person's thinking of something, then there's
probably 10 others.
There's probably 10 or 20 others. But there's one that came through yesterday, which we get a lot in different variations of the same question, which I thought we'll kick off with. So, hey fellas, I've got a question for the podcast. If someone has a modest stock portfolio, roughly 20 grand, is it worth having an investment split between stocks and bonds, as recommended by Ben Graham, who we like?
Yep.
My uniformed brain tells me that if you have a small amount invested, the split isn't worth it. Enjoying the show, keep it up, blah, blah, blah. So it's an asset allocation question, right?
Basically.
Yeah, we're essentially going... Well, the question is, if you reframe it, how much money can I earn in a short period of time?
Well, yeah. How do I get rich in the shortest period of time? Not being rude, but just by, hey, everyone would like to get rich really quick. It's like, cool.
Yeah.
Okay.
Yeah. There's the difference between financial independence, retire, like bullshit Ponzi schemes.
Yep.
And everyone just wants to earn as much money as possible with the least amount of risk.
Yeah. Well, especially if you've got a small amount.
Yeah.
So, investing, well, I'm not investing 20 grand, so I don't say buy junior specky miners because, hey, bro, if you hit it, you got a 10 bagger.
Yeah.
Right? I don't need to hit 10 baggers. So the investment strategy is different in terms of the amount of money. But this fella's obviously, probably young, whereas I'm old, and so it's like, well, hang on, dude, you got 40 years, I don't have 40 years. So there's just different aspects. In each individual case. But I think what he's sort of saying, my uninformed brain tells me that I only have a small amount, the split isn't worth it. Yeah, the argument is stocks and bonds are uncorrelated, and I think we talked about this last week, where if stocks are falling, bonds are rising. Oh, okay, and if bonds are rising, if bonds are falling, stocks are rising. So therefore, you don't get 0 in bonds, 10 in stocks. If you mix it, you get, say, 7.
Yeah.
Right? That's the idea. So it smooths the volatility, right? Mm-hmm. And it involves rebalancing and stuff. If you've got a small amount, you've got a really long runway, which is good, but it's pointless, let's do the numbers. I got 20, this young fella saying around 20 grand, right? Let's say 20 grand. Okay. Yeah. So you can say, all right, well, how do I make 20 grand turn, get more and more over time? If you look at stocks, they're generally okay for the long term. Now, as we sort of say, well, yeah, if it was 2009, I'd say, listen, mate, stick your 20 in the market because you probably do really well.
Yeah.
Right? So his 20 would have become, around 60 or something, right? But generally, what you've got to do is, in most cases, it doesn't matter. The amount of money you invest is like, as I say, he's got 20, I might have 2 million. That's the difference. But it's still saying, but if the Cape is 10, I'll invest 1.5 million and you'll invest your whole, 18,000 of your 20.
Yeah.
Right? But I haven't got any more money coming in, but you have.
Yeah,
right?
so that's an important question. Like, how much? I'm assuming this guy is working, so it's not as if he's got $20,000 and I've only got $20,000 for the rest of my life.
Yes.
There's likely an income or an inheritance or whatever else from elsewhere coming in. And I think what we're saying is, right now, with the market being so, where are you investing to start with? But if you're investing in the US market, it's so overvalued. So rather than putting all your 20 in that right now, you might be looking at putting more in bonds right now and waiting for the market to cool.
Or cash, right? And say, well, listen, mate, I know you're getting 5 and I know the market's going gangbusters, but there'll be a time when the market crashes and you'll say, well, now I can get 15 in the stock market, so I'm going to move it out of my 5 and put it into the 15. Yep. But we talked about it last week by just saying this is the part where you can't control, right? You can only look at stuff and say, okay, for example, Brazil's really cheap, right? Korea's really cheap. Mexico's really cheap. There's Poland is really cheap. Now, you can spread it across there, but with 20 grand, again, it depends. You might be better off saying, well, I'll put the 20 in Brazil, 10 and 10, right? 10 in cash and 10 in the Brazilian ETF, and that ETF earns me 7%.
Yeah.
Right? Or I'm going to put 5 in Brazil, 5 in Poland, 5 in Korea, 5 in Mexico, and I'll leave it there for an extended period, right? And I'll build up my cash pile through, I'll save my $100 a week, and at the end of every year I'll have $1,200 to, invest if I can.
Yeah.
So it's just the other thing that what you find a lot of young people do is they speculate heavily. They speculate heavily into really speculative, volatile stuff, right? Bitcoin, options, right? They, my options. I said to you a couple of weeks ago, I have put options on the US, right?
Yep.
Now they went up 50% in a week,
and down again.
And now they went to minus 2% yesterday. And then I checked this morning and they're up 3%, so, 5%. But my point being, options are great. You'd look at it and go, oh, man, Steve should have sold out last week when he was up 50%, right? That's what happens. But the big point is leverage. So, again, with property, you're taking your 200, you're adding the bank's 800. So when the property goes from $1 million to 1.2, that's made 200,000, right? But you had 200,000, so your 200,000 has now gone to 400, right? Because you get to keep the 200, pay the bank back. You've made double your money.
Yep.
Now, how did you do that? You did that by leverage, right? And so options are really just like a form of leverage, right? But there's things such as these days on the ASX, there's a range of leveraged ETFs. There's, and this is not advice, but there's a really good one bought out by Beta Shares, which is 1.3 leverage. So the market goes up, your leveraged ETF will just go up a little bit more, right? 1.3 more, right? So the market goes up 1%. This ETF will go up 1.3, 1.4, maybe only 1.2, but it will be better. On the downside, it goes down more, right? So you've got to be aware of that. But my point being, if you've got a long runway, those things can be quite effective.
Yeah, that's
right?
a good point, actually.
Because you magnify your returns. And if you say to me, Steve, I don't need the money for 5 years, it's like, okay, well, use that and rebalance regularly.
Yeah. Because you've got your BB US, you've got your GEA, which are leveraged as well. So
yes.
it's worth thinking about that rather than just your 20K in cash or 20K in bonds. Or
It's always to, this fella should send me an email and I'll have a longer talk to him. But it's because all investing is the same. Like I always look at this and go, oh, okay, that's an asset allocation question, right? Yeah. Well, actually, it's a rebalancing question. Yeah, that's true. Actually, it's a market cycles question.
Yeah.
It depends if he buys low, sells high. So it's like, you know, it's the whole 8 principles of investing, right? But and if the cape was 10, I'd be saying to him, listen, mate, stick it all in your stocks and you'll be fine, right? You're a young guy, you got an income, young guy, young girl, got an income, you know, blah, blah, blah. So, but generally, again, you just want to follow the yields and the time frame. And if he said, Steve, I'm 25, I go, okay, put some money in. Have you got a secure job? Yeah. If a recession hit, would you be all right? Yeah, probably. Okay, well, you'll be saving $100 a month? Yeah. Okay, well, just, you know, hold that, wait for the market to, and when the market dips 5 or 10%, then put more in. But then when it goes up, take it off.
Yeah.
Right? So you're building it over time. And that's the most difficult thing in investing is saying, I've made a lot of money, sell it. Right? Or, God, the market's fallen a lot, I'm going to put more in. It's really hard to do. But if you take that time frame perspective where you say, hey, if it falls, oh, that's all right, I've got a job and I'll put more in. And in fact, I should be happy because, as Warren Buffett said, if you're a net buyer, you want cheap prices, right? Why? Because the yield is improving.
Yeah.
Right? And so it just, the other thing I want to mention, Jacob, is at the top of the market, when we've seen an explosion in stocks, an explosion in property, an explosion in Bitcoin, an explosion in art. You know, you were saying to me about your car, the Mustang, right?
Yep.
You sold it for more than you bought it for.
Yeah,
I mean, that's nuts.
I put 70,000 Ks on. Yeah.
That's what I mean. You look at it and go, what the hell? How do you do that? You know, they're the rare things.
It wasn't that hard to sell it, surprisingly enough.
But that's what I mean. What I'm saying is you get euphoria and a guy says, you know, yeah, I know you paid 65, but I'm going to give you 80.
Yeah.
And it's like, dude, I've also driven it for a year. Don't care, I want 80. You know, I want a Mustang. Yeah. That's what I mean. So if you at the top of the market when things are crazy, you get lots of dumb behaviour. It looks short-term smart, right? But it's dumb behaviour over the longer term, right? But what you do is you find, well, you just buy Bitcoin or Mustangs or art or bananas or stocks, or it doesn't matter. You just buy anything and it goes up. That's when that's the equivalent of everybody being absolutely legless at the punch bowl, right? Everybody looks around and we're all having a great time and it's never going to end and there's more people coming into the party and they're getting into it as well, right? And then it peaks, right? And that's the way cycles and history shows us. So again, his 20 might be 60 in 5 years if he waits until the market crashes and then buys, right, when he's got 25,000 saved up, right? Or you say, all right, well, I understand what Steve's talking about. I won't buy bonds. I'll just buy a couple of cheap ETFs, right? Or I'll use that leveraged ETF and I'll rebalance every month.
Yeah.
Right? Get a strategy and
get
stick
the
to it.
framework in place.
Yeah,
first,
because what I can tell you is it's when shit hits the fan, people change their strategy.
Yeah.
Right?
Well, with 20,000, I mean, if I was looking at 20,000, I probably wouldn't be considering bonds. I'd be looking at ETFs and cash.
Yeah, and you know,
just rebalancing
if a cash is paying, say, 4.5%, right? What you can do is you can say, all right, well, I might invest in an ETF that pays 5%, right, and I'll probably get some capital growth, right? And so that's where you say, okay, well, I'll probably get 7. Okay, I'm not going to get 17, right? It's not like Bitcoin where I'm going to wake up and go, oh, my 20 grand's now 84, right? That's not the way it works in stocks.
No.
So that's just the different characteristics. You know, you might make 84 in Bitcoin, but it might go back to 5.
Exactly, yeah.
You just got to say, well, what's my risk tolerance? I'm really risk tolerant. Okay, well, hit Bitcoin, right?
But make sure you have a framework in place.
Yeah. Just make sure you know what, your 20 should become 5.
Yeah.
Okay, I don't want to do that. All right, well, you can go into the VAS, right, ETF. Right? Okay, well, that'll plod along. Blah. No, I want a bit more than that. Okay, well, look at the leveraged ETFs. Just be aware they're more volatile and you might want to rebalance more often.
Yeah.
Right, okay, well, that's what I mean. You see what I mean? It's those questions where you've just got to look at the circumstances and figure out. I can tell you the biggest issue is figuring out your risk tolerance. Because if you walk out, and I say this all the time to our clients, if you walk into a financial advisor's office and you say, "G'day, mate, I'm 25 and I've got $20,000 to invest," they will, for example, they might say, "Okay, well, let's put it in the stock market, right?" And away you go, right? What's your risk tolerance? Oh, well, I'm young. Okay, well, you got a long runway, got a job. Yeah, okay, well, you should be at higher risk, right? Now, walk in when the market's fallen 50%, right? And your risk tolerance level will be completely different, right? You'll be going, "Man, this is like really scary. This is really dangerous," right? Why? Because the market's lost 30%. And, that's what I mean. That's not a function of age. That's a function of your personality. Oh, now I'm really freaking out. And that's what happens, right? When the markets start to decline, the risk tolerance suddenly changes from,
optimistic to pessimistic.
Yeah, really, really quickly.
Very quickly, actually.
That's why we're saying to people, if you want to get in, but dance really close to the door because, things are going to move pretty quickly.
Don't drink too much. Oh, so I think we've answered that. Ran a roundabout way, but if this guy wants to reach out, you're happy to have a chat with him?
Yeah.
Okay, cool. I want to move on to this one because it's going to trigger you, and we've still got a few minutes. So this is from a few weeks ago, and we've chatted about this and had a laugh personally. So this is about property prices, left to right. They always go up.
Yeah.
Right. So you guys are starts with this. You guys are completely wrong. ... Spain.
Good stuff. It's good to get your...
Yeah.
What's your opinion, mate?
You're wrong.
You're wrong. Thank you.
Spain. Prices have been a roller coaster since the 1970s. Prices are literally going up and down so often you get nausea looking at it, even going into negatives multiple times. The highest was around 87, 88 during the GFC, lowest during the GFC in 2012.
Yep.
But it's been negative 6 times over 59 years. Its charts are nothing like the other countries. China was heading always in a pattern of increasing, then boomed during the pandemic, and now back to 2017, which isn't a collapse! ! Japan. Prices peaked in 1991, dropped around the GFC in 2010 to 1981. Prices then been steadily climbing back up to its peak prices again, no collapse. Ireland. Their prices are higher now than ever after dropping GFC times 2001. Do you guys think we can't see the info online or something?
No, please check online. Now, let me address that in seriousness.
Yep.
It's when you buy and when you sell, right? Now, the other thing is what happens is one of 100 events that can happen. So let me deal with the first one, right? The Chinese property prices are now back to 2017. Okay, what happens if you bought in 2019? Right? So I know people that bought in Perth in 2014 at the top of the bubble, at the top of the peak, right? Now they're just getting back there. Okay, well, great. 10 years worth of doing nothing for your investment. And in other words, you lost money. Okay, so again, this is where I talk about generalizations versus the individual. Now, I could say to you, I know this guy or this girl has made an absolute ton of money buying in and out of the Spanish stock market, the Spanish property market, right? Most of us don't buy in and out of the Spanish stock market, the Spanish property market or the Irish market. So again, in every transaction, there is a winner and a loser. Not everybody wins. That's not the way markets work, right? If it did, they wouldn't crash. Right? When they crash, someone loses money. Now, the fact, you imagine if I said to you that statement, right? The Irish market crashed and now it's back up again. Okay, so you buy it at the peak, you sell it to me at the bottom, I make 70%, and this person says, well, see, they've gone back up. How do you feel about it?
Yeah.
You feel like you're a dickhead because you sold it to me at the bottom.
Yeah.
Right? But again, I'm saying, yeah, but the whole market went up. I get it. But the question is, did you win or lose? Now, what are we saying? What we're saying is all of those people who bought at the top and sold at the bottom, guess what? They're the losers, right? When do you lose money? Mostly when you buy at the top. Okay, do you permanently lose money? I don't know, but I'm just telling you, you're not going to make a lot of money when you're paying for something that's expensive, right? We see this in every market, and this is exactly the response we get. Yeah, the markets go up and down. It's like, I know, I'm not talking about the markets. I'm talking about what happens to you as an individual if the market conditions are the way they are.
Yeah.
And so this is the sort of whole point of trying to explain market cycles and the difference between you and me. You lose because you bought it too expensive. I win because I bought it off you when it was dirt cheap and you were begging me to sell it. Then it went back up again. Get it completely. How many people like you say, oh, I've just bought at the top. I'm now down 50% in this mother of a crash, but it's okay. Why? Oh, because I know it's going to go back up again, right? And again, this is the second part. The second part is a thing called path dependence, right? It could stay low for 20 years. It may crash again, right? I don't know. And that's why I look at the things such as the yields to say, look, I'm going to get 10%. If it gets ugly, I might even get 12.
Yeah, if you're
Right?
looking on a chart from left to right from 1890, it looks
It
rosy.
looks great, but
what's
I
the
didn't
yield?
button will buy a house in 1890,
Yeah,
right? So I haven't got all the left to right. I've got a snapshot in there somewhere.
Yeah.
Right? But again, the second part there, path dependence, is it's like you get dealt an ace, right? And you think, okay, I'm playing blackjack, right? You deal me an ace, right? And you're the house, and you deal yourself a 6.
Yeah.
Okay? So I look at it and say, well, I've got a good chance of getting blackjack, and Jacob's got a good chance of getting a shitty 16. Right? So I say to myself, okay, look, I'm not 100% certain, but the probability is that I will win the hand. And since I've got an ace, I get a picture card, I win a lot of money, I'll bet more than average. Right? Because the probability is 80% of winning. Okay, instead of betting $5, I'll bet $8. Okay? So if I win that hand, that hand's decided. The mistake people make is saying, oh, well, every ace I get, I'm just going to be a winner. So I'll just bet all my money on aces, right? Which is wrong. Now, let's deal another hand. You get a 7, right? Not much better. And I get an ace. Here we go again. I'm in for a winner. Then you deal me a shitty 4. So now I got 5 or 15. You deal yourself a king. Now you've got 17 and I've got a shitty 5. So I might get 15 if you deal me another card. So I'm still behind your 17. So then at 15, I'm going, well, I'm a loser. Jesus, I've got to get a card that's below 6 or more than, I've got to get a card that's more than 3.
Yeah.
Right? So you deal me a 7. There you go, I've gone bust. But I had an ace to start with. Right? That's path dependent. So what I'm saying is when you tend to have this hindsight bias, right? So on an individual basis, you can lose money because your individual path is completely different to the path of the whole market, right? Because you might have bought at the top and then it crashes 50%.
Is this ergodicity that you talk about?
Yes, it's ergodicity,
Yeah.
right? But again, it's distinguishing between the individual path and the path of the whole market. In the property market may go up, absolutely, but there might be 1,000 investors that lose money. So it's the same with stocks. The whole stock market goes up, and you can buy an ETF that buys the whole stock market. Okay, well, that's super safe, right? Super safe. But there are individual companies that you might buy that go bankrupt. But I can make those statements that person's made. Well, the Irish market went down and now it went back up again. Yeah. And it's like, okay, but what about the people who bought at the top? Yeah. Well, right? They're not sitting there going, you know what, like we said last week, right? They're not sitting there going, you know what, I'm so glad the property market's, booted again because I lost 30%. And I sold out at the bottom, right? But I'm really glad Jacob's made a shit ton off my property, right? Yeah. That's the really important question. All we're doing is saying to people, the market, everybody's drunk at this party. How do you think you're going to go? Right? Now, you may or may not get lucky, but what we're saying is generally when everybody's pissed, there's going to be a fight or a punch up or they're all going to be hung over. You may have a magic pill, right? Where you can drink whatever you want and never get hungover. Good for you, but it's not going to happen all the time at this level. And it's what we talk about with CAPE, right? By saying, look, I don't know, it could go to bloody 40, 50, it went to 100 in Japan. But it depends, what we're saying is if you're buying when it's really high, you may succeed. It's pretty hard. Howard Marks said, if you buy a cheap stock in an expensive market, what you're doing is saying, my cheap stock is going to go up when most of the market goes down. And Howard Marks said that's hubris, right? So it's pretty easy to look backwards and go, see, you should have just buy and held. The second question is, okay, well, the market went back. How much did those people make? You seriously think Japanese property investors are killing it because it reverted to the mean? Okay, so did they buy another property at the bottom, or did they add a bedroom, or do you know what I mean? Like,
did they just sit and hold and?
Well, again, you can't do that with property. You can't say, "Oh, we've made 200,000. Let's sell the back bedroom." Well, you can't do that. So you've got to either sell the whole thing or hold on to the whole thing. Now, if it falls back down to 900,000, well, you didn't make 200, did you? Right? That's where, again, you've got to consider the characteristics. And that's what we did in stocks versus property, right?
Yeah, well, we've got two specials now that that literally explain this.
And that's what I'm trying to get across to people. Property is not something you can hack off every day of the week if it goes up 3 or 4%. It's a singular, big, generally leveraged investment. Now, you can make a lot of money. You can also lose a lot of money. And that's a really, really important point, right? Because if your property falls from 1 million to 600, like this person says, oh, well, they go back up again. Well, yeah, but you can't rebalance and go, oh, I'll just buy more of it at 600. You can't do, it's not a stock where you can buy more. You bought it at 1 million. That's your price, right? Now, if, as this person says, oh, they go down then go up again, it's good. Oh, great, it's gone back to 1 million. How much have been made in 10 years? Fuck all, right?
All right, I knew that I'd trigger you, but we get to the end.
I know, it's just, I just dislike people being aggressive like that by saying stuff when they haven't heard all the arguments. And I think it was the newsletter, I talked about disconfirming evidence.
Yeah.
Right? Look, if they say we're wrong, good. Yeah. Show me where they're right.
Yeah.
Right? Glib statements such as, oh, the markets only ever go up. Well, that's stupid shit, isn't it?
Yeah.
We know they go up, but we know they also go down. Do you want to talk about that bit? No, they just go up. It's like, oh, good. Okay, all right.
Yeah.
I lost 50% in the GFC. Oh, yeah, but don't worry about it. They just go up. It's like, well, no, I retired that year.
Yeah.
Right?
What's your yield if you held onto it then?
That's exactly right.
So there's one.
So there. No.
Oh, these
just kidding.
Made me laugh. The last one I want to talk about is it's quite a simple one, I think, but it could be a long answer. Can you explain more in detail?
Does that mean you want me to shut up?
No. Can you explain more in detail about CAPE, or what CAPE is, where do I find it if I want to read more about it?
CAPE is the cyclically adjusted price earnings ratio. Okay, cyclically adjusted. Ben Graham, later on Robert Schiller, said, how do I invest money over the business cycle, right? So we know there's recessions and we know there's market tops, right? Or the economy peaks at 4% growth and then starts declining, right? Because it just can't keep going exponentially at 4%, right? So what Schiller said was, well, look, if we look at the earnings, right, of companies, they sort of follow a gentle, rise and fall through the business cycle, right? I'm selling so much more booze. Why? Because the economy's going really well and everyone's buying my booze. Then the economy hits a recession. Okay, they're not buying my booze. Okay, so instead of making $1 a share, I'm now making 70 cents a share. Okay? Then, the government says, we're going to spend a lot of money. And everyone goes, right, let's buy booze, right? So they all buy booze again and I go back up to $1.10, right? Then I go back down to 70, right? So you get this wave-like motion. What Schiller said was, well, what you should do in order to invest over the long term, you want to average out the good years and the bad years. So think of 100 men in a room. The average height is 5'10". We get 5'10" from 5'7" men and from 6'1", right? Put them together. There's the average. So what Schiller said was, well, look, when the guys who are 5'7" are walking into the room, you know that it's going to get better to get back to 5'10" as the average. So we're going to get some 6-footers walk in the room. Mm-hmm. Okay. So what I should do is I should buy when the 5'7" blokes are there because they're below average, and I'll make money when it mean average, right, reverts back to the average of 5'10". So you buy at 5'7", you make, quote unquote, 3 inches, right? Mm. So that's where you profited. If you buy at 6'1", you're going to lose as it reverts back to 5'10". Mm. So if you go to the market and say, oh man, things are pumping, and it's like, yeah, because a lot of 6'1" guys have walked into the room. Mm. So you go, oh, okay, so last 2 years, I've got 25% the last 2 years. Okay.
Well, in this case, 8'9" guys have walked into
That's
the
exactly
room,
right.
and everyone else is
Yes.
5'7".
Yeah. The Harlem Globetrotters have walked into the room and you're now going, this is normal. And it's like, yeah, no. Mm. So Schiller says what you want to do is adjust the 5'7" and 6'1" and the 6'8" and the 5'2", right, to average it out, and then say generally you want to buy stocks when they're cheaper than average, right, which is what Buffett said, right? So what's the average yield? 3%. Okay, what are they offering now? 7%. Yeah, but it's really ugly. I know, but it will get better. Mm. And therefore you should buy now because you'll get 7%. Most people are scared to do that because the market's fallen a lot. Mm. Right? And again, they follow the squiggly red line rather than saying the yield is now 11%. Man, oh man, I'm going all in. But if you say to people, yeah, it's the stock market, they go, oh, God, Jesus, no, it's fallen 40%. It's really awful. You see what I mean? Mm. What I'm saying is it's like coming to them saying, yeah, how you buy strawberries and you really love them, they're 50 cents a punnet. You go, oh, man, I am leveraging up on the strawberries, right, because they're cheap. Mm. If I come back next week and say, now they're $24 a punnet, you go, I'm not buying those bloody strawberries, right?
I'll wait again until they come back down. Right?
Exactly, right? That's what CAPE does. It doesn't do it perfectly, but all it says is if you invest your money now in this part of the cycle, and what you hear a lot of the experienced investors say is we're in the late stages of a bull market, right? So in other words, using the American parlance, we're in about the 8th innings, right? And there's 9 innings. So hence the reason why we say, look, if you want to invest now, by all means, but boy, oh boy, you want to be able to move quickly if things go pear-shaped, right? Keep your eye on, here's a technical indicator, keep your eye on the 200-day moving average, right? If it starts to go below that, that's when, technically bad shit happens, right? Below the 200. That's where you get momentum on the downside. Right, because a heap of traders will go, oh, we've hit the 200, time to sell, right, and that creates the momentum on the downside. Yeah. If the CAPE was 10, I'd be going, don't worry about it, right? You got a long runway. Yeah. CAPE of 39,
it's going to come down hard eventually.
Well, that's like I'm saying. We've got all these Harlem Globetrotters walking in the room. Eventually, there's going to be some shorter blokes.
Well, even when the 6'1" blokes walk in, it's lower.
Yeah.
So bringing it down there.
Yeah, absolutely.
So, okay, well, let's leave it there then for this week. Well, the next one will be out in the new year, I think.
Yes.
So we'll see you then, folks.
Cheers, folks.
Thank you.
As always, remember, we don't provide financial advice.